Hi everyone, welcome to this month's market update. So just at the back end of the domestic first half reporting season, and by and large we actually felt it was a pretty good period for many domestic corporates. The materials sector in our view was probably the standout. We saw some really strong results from companies such as BHP and Oz Minerals on the back of higher commodity prices, iron ore and copper as an example. But equally, building company James Hardie also delivered an exceptionally strong result. Other parts of the market that also delivered some good results came to the consumer discretionary, as well as some sectors of the industrial part of the market as well. And we also saw companies that have struggled in more recent periods. So companies such as Tyro Payments, which had an outage on its terminals throughout January, really saw a big sell-off in that business and delivered an above-market result as it got its terminals back online, as I said. Equally a result that surprised the market on the upside, and that saw the company up close to 20% for the month of February alone. And as many of you would know, we've been holding that company in our portfolio and been selectively adding to it over the journey, and we think it'll continue to benefit as the economy reopens, particularly given its exposure to cafes and tourism and the like. Our market was up roughly around about 1.5% over the month. This was in line with what we saw in global markets, albeit that hedged global equities were higher on the back of the stronger Aussie dollar. The dollar is now up close to 20% over the last 12 months, again supported by a rising commodity market, but we certainly feel that it's also a reflection of the underlying strength that we're seeing in the domestic economy, and certainly probably well positioned compared to many of its global peers on that front. Most interesting thing from our end over the course of the month, though, was the sell-off in the bond market. We saw a significant uptick in yields right across the curve, but at the long end of the curve, 10-year yields are up close to 80 basis points through February alone. And this saw the market have its biggest one-month decline since inception. Our market was down roughly around about 3.5% through February. Global markets also sold off heavily as yields jacked up right around the world. Our market ended up 10-year about 1.9%. We've seen some retracement through the early part of March. And we think that that's appropriate because we did feel that the market moved way too quickly for the growth that has been sort of baked into not only the domestic economy but equally the global economy. We think that financial markets, as I said, were way too sensitive to the potential for growth to come in the early part of 2021. Notwithstanding that, as many of you know, we've been underweight fixed income across our portfolios, both in a sector sense as well as in terms of our duration positioning. So the negative impact that we saw in that part of the market certainly didn't flow fully into our portfolio. So that decision has certainly worked well for us. But I think it does highlight the risks associated with the fixed income sector. As we've spoken about previously, we expect bond yields to rise as the economic environment improves, and that's going to have downward pressure on the performance of that part of the market. Now, we don't believe that's going to happen anytime soon. As I said, I think that the sell-off that we saw is probably a little overdone. And certainly if you look at the commentary coming from central banks, cash rates are going to remain low for a number of years. Philip Lowe only mentioned last week that domestic cash rates are going to stay low until 2024. Or until they start to see, as I said, an improvement in the employment outlook as well as wages growth. So from our point of view, both of those are still a little way off when we think about it. And as I said, we think bond yields are now going to continue to probably track sideways in the near term. But the pressure on the upside is still very much there in terms of yields as the economic recovery takes hold. So we're going to maintain, as I said, that underweight position to fixed income and offset that in other parts of the market to take advantage of that growth outlook. Overall, though, as I said, February reporting season, I think, really sets a solid platform for the first half of this year. There's no doubt going to be ongoing challenges, but as the vaccine continues to be rolled out, as economies continue to reopen, we think that's generally going to be positive for growth assets, albeit that I think February did show, certainly the last week of February did show that as bond yields rise, investors need to be sensitive to the impact that can have on parts of the equity market. That's certainly something that we're going to be pretty much focused on when we think about our portfolio positioning for both our equity portfolios as well as for our multi-asset portfolios. As always, if you have any concerns or you want to discuss any issues relating to the portfolios, please feel free to reach out to any one of the guys within the team. Thanks, and we'll touch base again soon.